Alrighty guys, what is going up? Welcome back to the Best Investing Money Management channel on YouTube. In today's video, we are going to be talking about the one, the only, ticker symbol PYPL, also known as PayPal. This thing over the past couple of months really has been an absolute sinking ship. And a lot of investors have been reaching out saying, Carter, is this stock dead? Should you buy it? Should you just not even look at it? What is going on? So I hope you guys enjoy it. If you guys get anything in value out of this video, make sure you guys hit that like button, subscribe to the channel, and if you have any questions, make sure you ask them down below. Now, for those of you that don't know what PayPal is and you just naturally clicked on this video, well, PayPal is a fintech company, so it's a financial technology company. It really specializes in a variety of things, making online transactions safe and easy. It allows people to send money to other people, and they do have a whole bunch of crypto things that, in my opinion, are perfect for a long-term outlook on the general idea of cryptocurrency. So you can see over the past couple of years, really, we've seen great growth from PayPal, right? This thing was trading for about $94, had this great growth, had the March crash where it fell from 120 all the way to 82. People realized during this time that, oh my gosh, well, this company is really focused on online transactions, and everything shut down, and the only thing that people are doing are going online. This stock pretty much went parabolic. Within a couple of months, this stock that was once trading at $82 was hitting highs, up here at 213, giving a return of 156% in the matter of 8 months, which is a fantastic return with any sort of investment. And it did not stop there. It did have a little bit of some consolidation, huge spike back up to about 310. Now, this 310 mark represented the strongest resistance for PayPal. So resistance is pretty much just when a stock has a very hard time getting over a certain price. Okay, we see it hit it several times, right? It hit it once, hit it twice, just has that hard time breaking above it. Then it pretty much hits this 310, sells off, right? It had this massive decline. As you can see, it was right during this time right here. This is when a stock represents earnings. So this is when a company comes out and goes, hey guys, this is everything that's going on with our company, right? Maybe we made money, maybe we lost money. Here's some things that we're focusing on. Here's some things that we ditched. Here's our revenue. Here's our debt. Here's a whole bunch of things, right? So obviously, it did not pan out in PayPal's way. It had that massive sell-off. And at the time, people were freaking out, like myself, saying, oh my gosh, PayPal is down 12%. Maybe this is a good opportunity for a decent buy on this stock, right? Had a little bit of some consolidation, continued to just have that sell-off, right? Until their next earnings report. And you guessed it, it did not pan out for PayPal. Stock continued to sell off, have some consolidation, and then this. Another massive sell-off with earnings, right? So over the past couple of earnings reports, PayPal has not been doing the greatest, has not been living up to the hype. And it was kind of expected just because anytime you have a stock go up, from here, even if we're looking at highs, a stock going up 153%, you're going to have sell-off, right? It's almost very rare that you don't, and that's what we've seen. Now the stock is still up in value. We still have that long-term trend. It's just more volatile, okay? So the earnings came out, had that massive sell-off where the stock fell, in a single day just at about 28%, which is a very strong decline with any stock. Just to put that in perspective, the S&P 500, which is one of the largest indexes out there, has an annual return rate of about 9.8%. So over the past 90 years, it's gotten almost, we can just say 10% return. Okay, this in a single week had a sell-off double what the S&P 500 normally gets per year. So this is about 2 years of trading and not to mention all of this. Okay, so now the stock's sitting at about $114. Okay, this stock in literally less than a year has sold off 63%, giving a change of $197. So if you would have held this stock, you're losing your shirt right now. You're not in the best spot. So answering the question of kind of what's going on, right? We're looking at earnings, PayPal earnings. You can see the revenue is up 13%, which may seem like a lot, but when a stock goes up, 153%, you need something a little better than 13% if you want to get that afloat. The net income for this stock at around $801 million is down 48%. The diluted EPS, or diluted earnings per share, is down 48% again. The net profit margin is down to 11.5%, which is extremely bad for a fintech company. For a financial company that has very, very low expenses, that's not good. Just to put that thing in perspective, Tesla, which has a ton of overhead, has a profit margin right around the same, right at about 12%, if not a little better than this. And so this is one of the most important things they need to work on. Just to put it in perspective more, Visa, we all know Visa, the credit card company, online transactions, very similar sector, has a net profit margin at about 50%. So for every $100 Visa brings in, they profit $50. On PayPal, on the other hand, for every $100 they bring in, they profit $11.58, which is not very good. Okay, the cost of revenue is up a little bit too. Net change in cash is down a ton. Just everything about the stock lately has not been good. All right, so you can see on their last earning calls, they did beat the revenue, which was pretty decent, but looking at all these other ones, missed revenue, they missed their earnings per share. And you can see in September, they were up still 13% year over year. In June, up 18%. This is when things started to kind of get shut down more. Online transactions were up quite a lot. In March, up 30%. Okay, so this is during this time, right in here, where everyone was like, okay, all right, 30%, this trend's going to continue. Now 18%. So people are like, what? I am getting out of this. And the trend continued. Now it fell to 13, then 13.1 when it was 13.2. So the past earnings, have not been the greatest for PayPal. So answering that question of should you buy PayPal, I think it's very hard to judge. I think if anything, there is some opportunity, if we have some continuation, just on the technical side, it's very undervalued. You can see on the RSI, the relative strength index, it's extremely undervalued. But one thing that does concern me is these earnings. If the trend continues with that, this stock will be sitting at lows here at about $82, which is not very good. And I definitely think if you have that long-term outlook, you're going to be holding the stock for a long time before you see some recovery in it. They need to change something, and I think it's a matter of time before they do. But PayPal, guys, it does look like a sinking ship. If you were to buy it, the strategy that I would recommend so you don't continue this nasty trend would be dollar cost averaging. Figure out however much money you want to invest, whether it's $100, whether it's $1,000. And what you're going to do is you're going to invest weekly or monthly into this. So the beautiful part is if that's just a PayPal stock reverses and goes up, okay, you're going to make money because you have shares. But the beauty of it is when it continues to sell off, you still have money that you can dollar cost average it, that you can slowly invest back into it. As it's selling off, you're moving your average share down. So when it recovers, you make a lot of money. So that's kind of what's going on with it. I bought some shares of PayPal at around this $183 mark. Consolidated here. I'm down. I don't know if I will continue to hold it. Right now, when you buy something like this, you have to look at opportunity costs. So when you're holding money in PayPal, you could be missing out on opportunity elsewhere. And that's where sometimes it's better to just cut your losses. So that's one thing too, guys. Or you could just continue to dollar cost average it and, just hold it. But guys, that is it. Answering that question, should you buy? I definitely think keep it under 1% of your portfolio, at least right now. So what that means is for every $100 you have invested into other stocks or ETFs, put $1, $2 into this. And if you lose everything, you're only down 1%. But if this thing pops back up, you always can add more. And that 1% will make you a lot of money. So guys, that is it. I hope you guys enjoyed it. Take care.